Good morning, everybody, and thanks for joining us this morning on our Q2 Investment Market Update webinar. Most of you know me. My name is Jonathan Sheehan, and I'm going to be talking to you this morning for about 40 minutes about markets and how we're currently positioned. Just a small bit of housekeeping. Questions can be submitted at any stage. There's a Q&A button on Zoom. So my colleague Robert and myself will take any questions. We'll try to answer them during the webinar. If not, we'll endeavour to answer them at the end of the webinar. This is recorded, so you can watch it back if there's any particular slides or information or content that you missed, or pass on to any colleagues or friends that may benefit from it. And we'll also send the slides out after the webinar. So just to begin, market headlines. So let's take a step back and look at the big picture. So where we're currently at the moment, I suppose in the second quarter, markets were quite benign in that the level of volatility has been quite muted. There's a volatility index called the VIX, and you can see the chart for the VIX at any stage. And the VIX has been quite the level of volatility has been very low recently. So, in the last 3 months, and in fact 6 months year to date, generally markets have been more positive. But I guess that the uncertainty and volatility that we experienced last year and in previous years with COVID and that type of thing, we haven't seen as much of that. So that's generally welcome news because there's less stress and worry in markets. But as we know, there's always going to be something around the corner. At the moment, the Russia-Ukraine war is still dominating and other geopolitical tensions, but we'll have to watch the space over the coming months. In terms then of three key statistics, euro area inflation, Robert will be speaking about inflation later. So inflation has come down a bit, currently at about 5.5% in the euro area. There's different house price indexes and reports, but the most recent DAFT report actually had a 0.5% drop on a 12-month basis. So we're definitely seeing property prices in Ireland cool off. Whether there's going to be a correction, we don't know, or whether things will just remain as they are, flatlined for a while, time will tell. And finally, Irish unemployment rate. In our Q1 market update, we also had the statistic. I think it was 4.3%, and now it's 3.8%. So we are at full employment at the moment. So given all the challenges in markets and the economy and post-COVID, the Irish economy is still at full tilt, which is great from an employment point of view. In terms of markets, on the left side of this table, we see equity market performances. Robert will speak about that more in due course in graphical form. And currencies, we've seen, the dollar has weakened against the euro, which is quite significant actually for euro-based investors. So when the dollar weakens, obviously your non-euro dollar denominated assets will fall in value relative to the euro. And sterling has remained pretty much at a consistent level, since not long after Brexit. So euro sterling has been very, very consistent in the last few years. And 10-year bond yields, actually, Robert and myself were going through the presentation this week, and we have a couple of great charts for you in terms of the 3-year, 10-year German bond yield, and the 10-year US yield as well over the last 3 years, and how that yield curve has changed. So that's a bit more insightful. And what to look out for the remainder of 2023? Well, there have been some banking issues so far this year, and in the last couple of months, we haven't heard of too many other issues there. So hopefully that is behind us, but it's something just to watch out for if there's any more banking or liquidity issues. Will inflation fall back towards the target? Remember, central banks want inflation at around 2%. So we're on the way down. We're down to, in the US this week, the headline rate was actually dropped to 3%. So there is seasonality in different months of different figures coming out, but either way, will we get down towards that 2% target? And how will China react in this whole Russia-Ukraine conflict? So, more summary points here. Look, the rate of interest rate increases by central banks in 2022 was quite unprecedented. So how that's going to play out now, are we at peak rates? So interest rates were the big news story last year, along with Russia, Ukraine, obviously, but the two were interlinked somewhat. So that's been a big market headline. How that'll play out, time will tell. Last year, it's a very interesting point here. Usually one would expect equities and bonds to be inversely correlated. So equities are strong, bonds fall. But last year was the first year pretty much ever that both equities and bonds fell at the same time. And this particular statistic is saying in the US, the main index, the S&P 500 and the 10-year treasury both fell by more than 10%. So we have come through a fairly horrific year for markets in 2022. Tech was a big laggard last year, particularly badly impacted. Tech stocks, growth stocks, speculative stocks, one may say, but they have recovered somewhat this year. And the NASDAQ index has been a star performer so far this year, and that's the technology stocks generally. Russia-Ukraine conflict, no real signs of abating at the moment. And one thing we get asked pretty much every week is, what to do with cash. And I will speak about that later on, but ultimately the deposit rates available from Irish banking institutions are nowhere near as high as they should be or what their counterparts in Europe are. So it does create challenges in the short term for surplus savings. So now I'll pass on to Robert, who'll speak about inflation, interest rates, and bonds.
Thanks, Jonathan. Hey, everyone. I'm going to talk to you about a few topics here. You can see we're discussing interest rates and inflation firstly. And there's a lot of background there, information in terms of Jonathan, what he provided. So I'll touch on that as I go along. As Jonathan alluded to, all interest rates are cooling off globally. That's the indication, is that we're reaching a peak. We're coming near to a peak, somewhere in the 5 to 6% range, depending on the country. And it's likely that in the second half of this year, particularly in the US, we may even see interest rates fall. So that could be a very interesting phenomenon. I didn't expect it to happen that quickly, but as you can see with the US, where Jonathan mentioned core inflation is down at 3%, the ideal is 2%. They're trying to race ahead. I think I said it back in January that they're pushing to make the most aggressive moves as quickly as possible so that they're out of this cycle as quickly as possible. And they could well be the leader of the pack coming out of this, but we'll have to wait and see. In terms of the consensus, as we said, the average is 2%. You never quite reach 2%. In some instances you do, but it's always transitory, it's temporary, and then you revert back to normally a higher level, somewhere in the 2 to 4% range is ideal. So you could argue in the US that they've actually reached their optimal inflation level, but they will still likely continue tightening a little bit more. All indicators are pointing that at the end of this month, we're going to see another small, potentially a 0.25% interest rate hike in the US as well, which would feed into the narrative that we're seeing in terms of what the overall market is expecting. In terms of central banks, they have to cool inflation, as Jonathan said. It's absolutely essential that they do that, and the mechanism they use for that is the increase in interest rates. We're seeing that all across the UK. We're seeing at the moment in the UK they have 5% interest, as Jonathan said in the first slide. In Ireland, in the ECB, we've got 5.5, and obviously in the US, we're somewhere around the 5 to 5.25% mark. But central banks, as we've alluded to before in the past, they want what's called the Goldilocks scenario. They want the economies to be not too hot and not too cool. And this is the mechanism they use to cool down the economy. They basically encourage saving, and you could say potentially discourage spending, overspending, or the power of spending, which is what's actually causing the inflation that we've seen over the last 18 months. There are those rates I was discussing. You can see the UK, interesting on the Bank of England, actually, just to make a point, back in December 2021, which was just slightly over a year and a half ago, interest rates in the UK were 0.1%. So if you look at that and you take that into account and you look at today, it's 5%. It's likely to be higher again before we reach September. You can see the condition of the UK market is very stark at the moment. If we take a look at the focus on inflation, just zooming in on Ireland particularly, it has been quite dramatic. I have a few statistics for you on this, actually. In October of 2022, we saw 9.2% inflation, as we know. We discussed that back in December. We're now down to the 5.5% region at the moment. In terms of the 9.2% inflation rate, that's the highest it's been. The last time we saw 9.2% inflation, was back in 1984. So it just gives you an idea of actually how high inflation reached in October of last year in 2022. And we're beginning to return down to normalized levels again, but we're still at an elevated level. The average inflation in Ireland is, again, somewhere in the 3 to 4.5% range. So we're still at elevated levels. And that's something that's being addressed, obviously, across the ECB, with ourselves being a member of the Eurozone area. If we take a zoom in and look at inflation numbers, just in terms of CPI growth, this is our 21st straight month that it's been over 5%. I think the usual culprits, as everyone will feel and can recognize, food is still, appears to me anyway, to be at very elevated levels in terms of costings. Electricity, we haven't seen come down. There's been a very long lag on electricity, far longer than it should have been, but there's a lot of fudging potentially going on there. I think electricity should be far lower, but it's not. We're seeing gas prices have come down, but a lot of the costs of the restaurants and hotel industry, as you can see, we tie back into food and non-alcoholic beverages. A lot of that's being fueled by the energy levels that it takes to actually provide that to us and to bring that food to ourselves. In terms of the 10-year US bond yield, as Jonathan stated, we decided to, instead of giving a year-to-date view, we wanted to give the last 3 years in particular, just to give a real scope of what's actually taken place, just coming out of COVID. Obviously, in March of last year, 2022, we had the Russian-Ukraine war began. And here we are, you can see just in October of 2020, we were at 1%, and now we're at the 4% range. It's cooled off ever so slightly there since October of last year, because there is anticipation that potentially interest rates could lower in the US, but that won't be until Q4 and maybe into 2024 as well. If we look at the inverse of this on the next slide, you will see that the 10-year German bond, well, when I say the inverse, to a slightly less elevated level. With the German 10-year over the last 3 years, looking again over that period, you'll see that actually, if you go back to even just October of 2021, there was negative yield on that bond rate. If you see just in the chart there towards the center, as Jonathan's highlighting on the cursor, there was a negative yield, but now you can get 2.5%. So it just shows you how volatile the market's been and how quickly the market has swung into an interest rate bearing situation to cool inflation. That's the rapid pace that we've seen in the EU in particular. If we look at equities and currencies now, we'll just zoom in for a moment on the equity market indices. We've taken a 2-year period on this up to the 30th of June 2023. It's quite busy in terms of a chart, so please forgive me. If we have a look, the main leaders, as you can see there on the left-hand side, down the bottom left-hand side, you can see the S&P 500, NASDAQ 100. These are the top companies by market cap, the Euro Stocks 50, top European companies by market cap in the Eurozone area, and then obviously the FTSE. They've been the market leaders. A lot of the market growth we've seen over the last 2 years has been driven by tech, by the largest tech firms, the FANG stocks, your Googles, your Apples, your Netflix, and so on. So that's been pushing a lot of the growth, but it's great to actually look at a 2-year chart rather than zoom in on a 6-month chart, because if we just took a 6-month year-to-date snapshot, you would see almost everything being in positive territory. And particularly if you look at the Nikkei 225 there, you can see it's minus 2.95% over this 2-year period. But if you were to only take it from the beginning of this year, you would have seen that it's actually up 27%. So it's important to take a look at the macro, step back, and actually look at these indices in context. And that's why I think this paints a particularly important picture. If you go back to October and you look at the chart, you'll see that almost all of these indices were in negative territory. So market volatility is very common, but it's important to take a step back and actually look at the wider picture. And that's what we're doing here in this instance. But volatility is dominant. I think that's what plays out more than anything. Now, if we look at the Euro-US currency comparison between the two over the last year, you can see that the US dollar has been very strong. It was quite weak back there in 2020, but it's actually, it was very strong back in 2020, but it's actually weakened in the latter end not because, well, for one particular reason, it's really because interest rate expectations are expected to lower. So with the US, although it's now at 110 on the euro, we may actually see that weaken a little further still as the interest rates in the US dollar will or may potentially lower towards the back end of this year. On the other slide, the next slide, if we look at the euro sterling, you'll actually see the inverse. So the sterling is actually strengthened ever so slightly against the euro. We saw back in March of this year and in December of this year, you would have gotten 90 pence to the euro, 88 pence to the euro. We're now down in the 85 pence on the euro range. And the reason for that strength in the sterling is because the expectation of interest rates staying and sticking for longer on the sterling are stronger than in the US, because the UK has some ways to go. Their inflation rate as of June was 8.7%. As Jonathan mentioned, we've got 3% in the US. So you can see that the UK has a lot more to do, but that means interest rates higher for longer, which is adding to the strength of the sterling. I'll now pass you back to Jonathan, who will discuss the asset class changes.
Thank you very much, Robert. Yeah, I found the German 10-year chart particularly interesting, given that it wasn't that long ago where you would have had to actually pay the German government for the facility to mind your money. So when negative yields like that, it was quite incredible. And just to see how quickly things have turned. And when a bond yield goes from minus 0.5% to plus 2.5%, that may seem like only a 3% increase in yield. So it may not seem that significant, but it has huge impacts onto the capital value of pre-existing bonds. Ultimately, that's why bonds sold off so much last year. But I guess bonds have now become an asset class, an investable asset class again, given that yields are more attractive. So higher interest rates, what does that mean? Well, it means that higher interest rates in Europe, depositors should be getting better rates. And unfortunately, we haven't so far. That's purely because, unfortunately, in Ireland, there's only 3 banks. There's Bank of Ireland, AIB, and Permanent TSB. We've lost the competitiveness that Ulster Bank and KBC would have provided. The post office on Post actually had increased their rates ever so slightly a couple of months ago, but nowhere near as high as they should be. So that's a big challenge for people at the moment on how to get the best return on their cash. There are some bond opportunities there, but generally it's definitely a challenge at the moment. As I said earlier, with bonds, when you see an increase in rates, in bond yields, pre-existing investors will suffer a sell-off in capital value, but it does offer a new attractive asset class for people with cash. I suppose when you see the dollar weakening, we have to think that if you want to be diversified in a diversified portfolio, you have to have a geographical mix, and you have to look outside of the Eurozone. So you have to look into jurisdictions like the UK with sterling, and ultimately the US and North America, which is dollar and Canadian dollar. Over 60% of the MSCI World Developed Markets Index is US companies. So if you want to get global exposure, you have to take on dollar exposure, and hedging can be very expensive and cumbersome. So when the dollar weakens, for most Irish investors, it is a headwind, and you will lose some of your value. And obviously the ideal is that equity markets go up and bond markets go up and the dollar strengthens the whole time, but it can't continue to strengthen. Currencies is the one thing that investment advisors like us will always struggle to predict, because there's so many different factors outside of your control that will dictate the price of dollar euro or sterling dollar, whatever it might be. So it's just one of those risks that is generally has to be accepted when you do allocate capital to markets. So as I said, you know, when the dollar is strong, euro investors will perform well, and when the dollar is weak, it'll be negative overall. And at the moment, the US market's actually at a 15-month high, but equally the dollar index versus other currencies is at a 15-month low. So a lot of the gains you're seeing in the indexes are not actually being brought through for non-dollar investors. So this is a chart we've shown before, and we just edited it a bit because the best way to think about investing through your pension, through a charity, or personally is the level of risk versus return. And the lowest one here is cash deposits. So by default, income is received in cash and it sits in your current account, and you may wish to place it on fixed term deposit ultimately it's low risk. I know there's 100,000 guarantee, so anything above that isn't technically guaranteed per bank, but all else being equal, cash deposits is lowest risk, lowest return. The next level up then is bonds. So the bonds are riskier than cash, and that's why you get remunerated for it. So moving up the curve, and this is how you develop a diversified portfolio. And then, to be honest with you, it's difficult for the next two, and I brought them in together here because they do demonstrate a lot of the same characteristics, property and equities. They're the two, what we call risk assets. And if you invest in those over the long term, you will pretty much always outperform what you would have got if you kept your money in cash or bonds. The issue at the moment is the volatility we've had in equities over the previous couple of years, but also property, domestic property in Ireland has become very difficult asset class because of the rent controls, rent pressure zones, 2% increases, and because of the regulation compliance that goes with it. So to become an asset class that is arguably very difficult to foresee strong returns, at least in the medium term. But this is just a nice graphical way of illustrating the target return you expect from the level of risk. And I suppose what you want is assets that would sit down here in this kind of section where you're achieving strong return with lower risk. And the best way to lower risk is diversifying by putting different, even say within the equity space, having different mix of geographies, sectors, investment styles, that type of thing. So what is the role of cash? Okay, so it's the default option for surplus cash flow and savings. And basically the best way to look at it is everything other than cash is an investment. Like one would argue that cash itself is an investment because you're getting a return from the bank but it's a really, really safe investment. So for the purpose of this, I'm differentiating cash from everything else. So it's a risk asset. So all cash really should be looked at is the layer in a portfolio, the first layer that can either be a nest egg or emergency fund. So you need to have something squirreled away in case something goes wrong. But also you can't have all of your capital invested because then you're just taking on too much risk. So having some cash is a natural diversifier within a portfolio. And I know your next question is, well, how much cash should I have, or should we have, or should the pension fund have, or whatever it might be? Well, it depends on a number of factors, and ultimately it's the risk profile. So different types of financial positions will require higher or lower levels of risk. And it just depends on the security of your income, your age profile, that type of thing. So again, when you look at markets, when you look at allocating your capital, I've broken this down into 6 different places where capital can be parked. So usually when people get valuations and they read reports and they turn on Bloomberg or CNBC, it can be quite intimidating with all the different charts and asset classes and funds here or there. The best way to think about it is that there's only 6 places where capital can be parked, okay? First is cash, we know that. Cash, your income comes in cash, it's there. The next one is bonds. So you can invest, move up the risk spectrum, look at bonds, corporate bonds, government bonds, whatever it is. We nearly always use bond funds because getting access to individual bonds is very difficult because of liquidity issues and minimum 50,000 tranches and things like that. Then you've got equities, shares, so US, Europe, different sectors, all that type of thing. And the next obvious one is property. So these are the 4 traditional asset classes, the 4 buckets, and for 98% of people, this is really all you're juggling with at any one time. So no matter what, no matter how complicated your financial affairs seem, no matter what is invested here or there, pensions, partnerships, trust funds, personal accounts, all that, 98% of people will have, we could categorize them into these 4 asset classes. And then for business owners, they have to, the value of their company, or if they're in partnership, they're 30% shareholding in the company, and a lot of that, it's pie in the sky. You're trying to predict, okay, I think the value is X and I own 50% of that. So for any business owners or people who are investing in private equity and investing in companies themselves, there's an allocation to that. And then The last one is an alternative, and that would be things like commodities and things like that. But alternatives is a very small asset class. It's basically anything that doesn't fall into the first 5 buckets. So even, for us, we invest in multi-asset funds quite a lot. And clients of ours will see in their reports that we categorize them as multi-asset. And it can be difficult because people say, oh, well, is it equities or bonds? And every multi-asset fund will have its own fact sheet, which will break it down into the constituent parts. And we can drill right down into that. So I just hope you find this insightful, just to categorize how all assets are. And part of a good analysis is break it down into this granular level, and immediately then we'll know what the overall risk profile is. So these are the different ways where assets can be allocated. So people talk about diversifying, where you can diversify asset class. As I said, the 6 asset classes we had in the last chart, but generally it's just those 4. Then geographically, so you would say, okay, within my equity allocation, how do I spread that? And traditionally, when I say traditionally, 20 years ago, people would have felt that if I buy shares in Kingspan or Aer Lingus at the time, and Bank of Ireland and AIB and whatever it might be, I'm diversified, but actually all of their exposure was into the Irish Stock Exchange. So now with technology and liquidity and funds available, we can build a very, very geographically diversified portfolio quite quickly. Investment types, that's a mix between, you don't want to have all shares, you may not want to have all funds, you don't want to have all bricks and mortar property. So it's spreading the type of investment as well. Custodian provider, and that's something that we feel is very important for us as an intermediary. We deal with all the different custodians, and I guess we feel that it's inappropriate for anybody to have all of their assets with one provider, even if they feel a provider is safe and the person they're dealing with is great. It's not prudent to have everything with one provider. Sector, so within equities, you want to make sure you could say, okay, I have my equity exposure and they're geographically diversified, but what if they're all tech stocks or they're all banking stocks? So you need to be diversified from a sectoral point of view. Liquid to liquid, like, look, we have a preference to have everything liquid. Some people, but if someone has shares in their own business, their private equity or rental properties, they're illiquid. So having a mix of liquid and liquid, not too much of each. And growth or income focus, that's important because, again, within the sectors of technology, sectors of equities, you don't want to have everything in a kind of a growth stocks. Like the kind of what a growth stock is a company that is rapidly growing. So you're not going to be getting a dividend from it. It doesn't have predictability of earnings over 20, 30, 40 years. And those companies may turn out to be the most profitable, but if you've too much in that type of company, you're taking on surplus risk. And the 2 main reasons for diversifying are to reduce your risk ultimately and to smooth out returns. Just looking here, a couple of questions coming in. That's great. Okay, so I'll be answering those questions. One question we have here is about interest rates and the loan and interest rates on loans and what you should do with surplus capital. It's a good question because, when somebody has capital, personal cash, let's say, there's always going to be choices on what to do with it. And the first thing we'd always say is you should have a nest egg, rainy day fund squirreled away in an account you don't have access to, under the mattress. And that's the most important thing. And to the extent that you have surplus, we always say if you're working and you're earning, pension contributions should form a part of it. But you would have to look at whether or not to pay down your mortgage. If you have a fixed rate, you may not be able to. If it's on a tracker, you do have that option. But remember that you're also tying up capital in a liquid asset, which is your home, that's more difficult to extract out. So you need to balance that with what the available return is by keeping it in cash. You might get 2 or 2.5%. Okay, you might be paying 4.5% on the loan, but you need to find that balance between will I need this money? Do I want to use this capital for another use? So I would say in a question like that on paying down loans, that's very much on a case-by-case basis. So outlook. So what's our outlook? Okay, so I'm going back to the same four asset classes. So cash, the rate of interest available at the moment is much lower than it should be on deposits. So we will definitely get higher rates. There may be a little bit of political pressure put on the banks, but I expect by the end of this year, deposit rates should be at least 0.5% higher available. So definitely, I think the ECB may have another 0.25%, maybe another 0.5% to go, and then it'll level off. And we're hoping that the deposit rates available from Irish banks will move up towards that. Bonds, obviously there are some risks with bonds, but definitely there's a better entry point now for bonds. And I think that entry point, the yields may continue to go up a bit. If inflation doesn't cool off as much, we may see yields increase a bit more. And then you'd say, God, I shouldn't have bought bonds in July 2023 because yields have since increased. But I think we have to summarize that it is a better entry point now than it would have been in previous, and there's more value at bonds, and I think that will continue over the coming months. We're with equities, we're in this kind of an in-between phase. I feel equities have recovered somewhat. They're still off the highs that we experienced before. They're not at all-time highs like they would have been in December 2021, early January 2022, but with equities, we are in a bit of a stable environment, but I would say that nobody ever knows what the short term, and this is what makes our job very difficult. We'll never know what the short term outcome of equities is going to be over the next 6-12 months, because there's always going to be too many external factors. But the one thing you do know is the longer the time horizon, the longer you keep funds invested in equities, the higher your percentage chances of outperforming cash. It's just that the short term is always going to be difficult. And with equities, kind of going back to what I was saying in the last couple of slides, the return is going to be better from equities as long as you avoid single stock exposure. Because if someone left this webinar and said, okay, Jonathan said equities are going to outperform over the long term, so now I'm going to put 100 grand into Tesla and buy Tesla shares. But the chances are that Tesla will outperform cash over the next 10 years, but there's also a very high chance that one stock will significantly underperform. So the only way of tracking how equities will perform over the long term is buying a fund or an index. So you're investing in hundreds of different companies, and then your risk of single stock exposure is completely mitigated. And property, like again, I know there's a couple of people on this call who have more experience with property than I do, but ultimately, yeah, it's an asset class that is a lot less attractive now for Irish investors than it would have been in the past, because firstly, individuals are now competing with institutions and big funds who've got more economies of scale in terms of repairs and dealing with tenants and the RTB and that type of thing. It's become a more regulated investment, because as you know, it's hard to be passive now with residential property if you're physically buying it. And as well as that, it doesn't look like the 2% rent pressure zone issue will in any way be gone anytime soon. So it's just become a more challenging asset class, and there will be some headwinds, I think, to what capital values will be producing over the coming years as well. So bull case for the next 6 months, interest rates have peaked and can begin to fall. That's going to be positive for equities. If we avoid a recession, will be the next one. And finally, if company earnings remain robust, that'll be a big bull case. And the challenges, if there's issues with, if it turns out that interest rates were hiked too aggressively, then that could lead us into a deep recession. Second one, if Russia-Ukraine escalates, which none of us want to happen, but that is a big risk. And the third one is if bank solvency issues re-emerge. So here are just some, I'm just conscious of time. If there's any other questions, I have 1 or 2 questions here coming in. But these are the general points: diversify, be mindful of inflation, be mindful of interest rates, and also remember long-term trumps volatility concerns in the short term always. So questions. Thank you for everybody for, I'm just seeing there's 1 or 2 questions coming in here. Okay, first question here is on currencies. Yeah, so where do we expect currencies to go? And that's, look, it's very, very difficult to see. We're at the rate where the dollar had been at parity with the euro, and it's ultimately dropped about 10%. It's impossible to predict which way currencies are going to go. It really, really is. You know, as Robert said in his piece earlier, when the dollar had strengthened so much, that was because of the anticipation that the dollar interest rate cycle increasing would be more aggressive than other currencies. And that's what did happen. That's why the dollar was at parity ultimately with the euro. But since then, you know, the euro has started increasing maybe more than what the markets had anticipated at that time. And it looks like, you know, with the data this week at 3% headline CPI in the US, that the US is definitely closer to leveling off its interest rate increases and in fact reducing interest rates, hence why the dollar has weakened a bit. Another question here is, yeah, so what is the reason for technology increasing so much this year? Well, I think that you know, post-COVID, there was a knee-jerk reaction to all tech stocks that, okay, you know, we're no longer staying home all the time, we're out and about, technology is bad, we don't need technology, and technology, which had been a star performer for quite a long time, sold off significantly in 2022. But I guess that this year, markets have realized that actually some of these technology stocks are really, really robust. The Apples or whatever it is, there's earnings that are backing up the share prices. And actually there's potentially more profitability to come with these stocks. So market ultimately changes mind, and now technology stocks are back in vogue. And the other thing is that when interest rates are aggressively increasing, the kind of growth stocks that trade on higher multiples, what a multiple is ultimately a higher multiple is basically like a company at 30 times earnings, they say, or 40 times earnings, means that your actual yield might be 2.5 or 3%, because the earnings might only be 2.5 or 3%. Therefore, the multiple is 30 or 40 times, whatever it is. And the reason why they're trading at high multiples is because the market expects the earnings to grow aggressively. So the real forward-looking multiple isn't as high. But when you have interest rate increases, then the risk-free rate of return changes. So therefore, the multiple is contracted somewhat and the share prices sell off a bit. But when interest rates look like they've peaked, by default, those higher multiple stocks become a bit more attractive then. So guys, we're perfectly on time. It's 10:40. We've got you out right on time. I'd like to thank Robert for his contributions. I'd like to thank all of you for attending. I hope you all have a lovely weekend. We'll send out the recording and the slides later today. And if you have any questions on the content of this webinar, any colleagues or friends who are looking for a wealth management firm, don't hesitate to make an introduction to us. We're always delighted to meet with new clients. Thanks for your time, and we'll talk to you all soon.
Thanks, everyone. Take care.